Hi, I'm Mike Helveston with Whitford Financial Planning. Today, we're going to discuss if you fail to plan, then you are planning to fail. This video highlights Chapter 4 from my book, Achieving Financial Fulfillment. If you fail to plan, you are planning to fail. This famous quote by Benjamin Franklin can apply to many choices, especially those about personal finances. If we don't take his message to heart, then a lack of planning can be costly. For example, let's take a look at an illustration. You can see here how important it is to start saving and investing early. This chart compares three different investors that started at different points in their life to build their retirement savings. Starting just 10 years earlier at age 25 instead of 35, the projected investment balance for Jack at age 65 is more than double that of Jill. Joey is even further behind by waiting until age 45 to start saving for retirement. An extremely important principle at work in the chart is compound interest. It's possible for your money to make more money for you with no additional effort. Let's look at how saving early can make a difference. If you invest $10,000 and earn 5% interest in the first year, you would have made $500 or 5% of the 10,000. And with this interest added back to what you started with, you now have $10,500. And the next year, if you start with $10,500 invested at the same 5% interest, now you will earn $525 in the second year. So your additional $500 earned in the first year made you $25 in the second year without any additional contributions from you, and so on over time. This compounding is how little numbers can become much bigger. Also, setting up an automatic savings or investment plan is critical. No matter how small you start, you won't miss it if it's out of sight, out of mind. For example, you could have a certain dollar amount coming from each paycheck going into a savings account. Further, you could put a fixed percentage of your salary into a retirement account, such as a 401k, in order to make sure you save on a regular basis and learn to live on what is left over. As you can see, financial planning is a process to help you achieve your goals over time, not just a once and done event. It also is about much more than managing investments to get the highest return. Investments are a key component, but there are many other items that should be considered. So there's 4 other steps to consider. Number 1, setting realistic goals. You need to set goals to where you want to be in the future that are realistic. If you prefer, you can work with an advisor who can help you to get organized. A written statement of your goals or a detailed plan can be developed to create a point of reference. Saving for retirement may be your most important long-term goal, but you'll likely have other financial goals too. Maybe you want to save for a vacation, pay down your debts, or buy a house in the near future. The second step is to assess your investment options. Investing that involves the use of stocks should only be considered when the time frame is long-term, generally 5 years or more. This is due to volatility and short-term declines that should be anticipated because of the many factors that could impact the value of a business. These can include changes in the company leadership, competition in the industry, or outside influences such as geopolitical events or changes in the overall economy. The third and final step, once your time horizon is understood, is to determine the asset allocation or mix of stocks and bonds, etc., to be used to achieve your goals. This is determined by taking into account the desired financial outcome and your risk tolerance, which is how much risk or reward potential is acceptable to you. Other factors to consider include how much money to set aside, your current sources of income, other investment and/or retirement accounts available, and the potential income tax implications of investing. There are many choices when it comes to investment strategies. A simple way to group them is to identify them as aggressive, moderate, or conservative. Determining the rate of return that will be needed or what is assumed in your projections is also an important part of planning how you reach your goals. You may need to be aggressively invested if you want to grow your money at a high rate of return, for example. So, from this information, an initial asset allocation can be determined. The asset allocation should be revisited over time to determine whether your investment strategy should change and to monitor progress towards your goals. The asset allocation between stocks, bonds, and cash is said to be the single greatest factor in influencing portfolio returns. That means that the specific stock, mutual fund, or ETF that you buy is less important than you may think. Obviously, finding the next great company and buying it when the price is low would be nice as well, but that is much less likely, and you should focus on what you can control. Things you can control are what level of risk you're willing to assume, diversifying in a way that allows you to capture the returns of the market over time, and reacting appropriately to what happens next in the market, or in many cases, not reacting at all. Investing with a target asset allocation in place works because it does not rely on you needing to jump in and out of the best performing funds or best performing categories. It allows you to stay focused on your long term goals. The inevitable volatility in the market then creates opportunities to rebalance your portfolio back to the target asset allocation. For more information, visit us at whitfordfp.com.